Welcome to this week's market drama. We'll start with the stock market. The S&P 500 was up 0.8% week over week. That puts it up 7.8 for the year. Now that's still down 13.7% from its January highs. Switching over to economic data, we did have March core CPI data hit expectations of 5.6% year over year. The one area that remains elevated is the service prices component. Notably in leisure categories such as hotels and airfare. Just from an anecdotal evidence perspective, my family had an Easter break vacation, and I could attest that hotels, airfare price just continue to go up higher and higher from prior years. And the place was, everywhere we went was full. Like doesn't seem to me like there's a recession going on right now based on just what I witnessed. Now, the other component that from a data standpoint that happened last week that's worth noting is that we did have producer price index data, PPI data. This data point captures inflation on input costs through the supply chain. And the trend here is particularly encouraging, with PPI falling 2.5% in March year over year. This brings the annualized PPI inflation rate down to 3.4%. The lowest in 2 years. So the trend in PPI tend to lead the consumer price index by several months. So this is encouraging, right, to see that, from a PPI perspective, inflation is coming down at a fairly rapid pace. Switching gears from the economic side to the banking system situation, I'm in the camp from like the last couple of times that we did a market drama. I'm in the camp that the Silicon Valley Bank and Signature Bank collapse will hurt consumer and business activity via availability of loans and the cost of taking out these loans, and that takes some time to kind of flow through the system. So in other words, like credit lending is going to get tighter, and that could also affect consumer confidence. But this past week, we received new data via Bank of America that showed that consumers continue to have a lot of borrowing capacity. Household credit card utilization rates are still below even 2019 levels. So U.S. economy still remains in healthy footing. Yes, it likely will get tougher to borrow. Yes, in a sense, we haven't seen kind of the flow-through effect of what happened to the banking system as a result of Silicon Valley Bank. But Americans consumers still have a strong balance sheet, and they still have their job, right? When you look at the unemployment rate at 3.5%. And the reason this matters is that GDP, 68% of GDP still is driven by the U.S. consumer, right? So as long as the U.S. consumer remains strong, it's unlikely to see a strong recession or a severe recession. This week, look for LEI, leading indicator, that to keep an eye on, as well as PMI data, Purchasing Manager Index data. They are both good proxies for signaling peaks and troughs in the business cycle. So it's one of those data points that is good to keep an eye on. That is it for this week. Stay tuned for next week.